If you're planning to buy an investment property or are curious about whether your property is more like the golden goose or a sitting duck, then this video is for you. We're diving headfirst into a step-by-step exercise to uncover the true potential of capital growth in your next purchase. So grab your latest land tax and council rates notice, and if you don't have them, don't worry, I've got some tricks up my sleeve. Think of it as baking a cake, but instead of flour and sugar, we're mixing land values and investment strategies. That's coming up. If you're looking to buy your next investment property, you need to do this first. I'm going to walk you through this exercise step by step to determine if your investment property has the hidden treasure or is just a money pit. And if it does have the potential for capital growth, together we will figure out if it is worth buying or keeping. Before we begin, grab two things for the property in question. One, your land tax notice, and two, the latest council rates notice. And if you don't have either, don't worry, there's more than one way to bake a cake. Step one. Determine the land value of the property, not the purchase value. We have to determine the land component in the property. You can do that in several ways, but the easiest way is to look at your council rates notice or land tax notice and check the unimproved value. If you have neither, the third thing you can do is find out the average land value per square meter in your area and multiply it by property's total size. And if all these fails and you still can't determine the land component, grab a copy of your insurance policy for that property. On your insurance policy, check the replacement cost of the building. That is, if the property was completely destroyed, what would it cost to replace it? Now subtract the replacement cost in your insurance policy from the purchase price. You will have the land value you are looking for. The land value can be similar or different from all of these methods, but it doesn't really matter. For the sake of simplicity, you can use any of the values you think are realistic, or you can average all of them. The critical difference is that you are not looking at the market purchase value of the property. You're looking only at the land component of your property in question. Step 2. Determine the purchase value of your property or what you plan to buy it for. And if you already have the property or you've already purchased the property, find out what you can sell it for today. This is fairly simple. Most websites will give you an approximate desktop valuation of the property as is. It may not be accurate, but it will be fine for this exercise. Step 3. Divide the land value of your property by the purchase or selling price and convert it to a percentage. We now have the land to asset ratio, which tells us the ratio or percentage of land component to the overall asset value. And here's why you need to know this. 1. Because it is a primary price growth driver. Why? Because over time, land value goes up, but the buildings typically depreciate. So in most scenarios, it makes sense to hold a property with a higher land component. Secondly, it is also an investment quality indicator. A high land to asset ratio indicates a good quality investment, indicating better chances for land value appreciation and redevelopment potential. Finally, it indicates depreciation risk. A lower land value ratio could mean that a large portion of the asset is subject to depreciation, negatively impacting the property's future value. So what did you get for your property? Let me tell you what that number means with a simple example. Let's say you have shortlisted 4 different properties: a house and land package, an apartment, a townhouse, and a single family home, all for the exact same asking price of $750,000. However, the land component is different for each of them, giving us 4 different land to asset ratios. So which one will you move forward with? The logical answer is the one with the highest percentage of land in it, but not always, and I'll explain why in a second. As a bare minimum, you should aim to have a 50% land component, and if you can get a 60 to 70% ratio, you have done well. On a side note, in case you are not doing as well as you would like to, and instead of going at 60 miles an hour, you would like to go at 100 miles an hour, then click the link below and schedule a call with me today. Okay, let's continue. Another important thing this ratio allows you to do is avoid the emotional biases towards dwellings' superficial aspects, so you can decide objectively without being influenced by the kitchen or the bathroom accessories. Now, you might ask, so what happens if I buy an investment property in a regional area compared to an urban area? In city centers or established inner suburbs where land is scarce and highly valued, the land value ratio can often be as high as 70-30, especially if it has not been redeveloped recently. In contrast, a regional property might have more value in structures than in land, with a ratio of 30-70, which could suggest lower appreciation potential. What about older properties? Consider an older building in a well-developed area. The building itself might have depreciated appreciated significantly, but the land value could be very high due to the location. Such a property might have a land value ratio of 80-20, making it a potentially lucrative investment for redevelopment. And what if I'm buying into a new development? In new housing developments, aka off-the-plan house and land packages, the initial land value might be lower than the construction cost. But over time, the land value could increase and as the area develops, altering this ratio favorably. If you are considering purchasing a property for renovation or redevelopment, focusing on a property with a higher land to asset ratio is essential. Remember that this ratio will decrease over time as you improve the building. Renovators and developers should estimate three things. 1. The current land value. 2. The current dwelling value. And the estimated value of the dwellings once they are completed. This approach helps you understand your expected land to asset ratio and avoid overcapitalizing your renovations or small developments. Remember, renovating the building doesn't increase the land's value. It only improves the value of the building. So why don't we just buy land? Wouldn't that be a good idea? Typically, the answer is no. Vacant land does not produce rental income and its debt isn't tax deductible because you cannot rent or generate any income from it. Additionally, vacant land often lacks the scarcity factor that increases land values and is rarely found in highly desirable areas. In a nutshell, properties in sought-after locations with high land to value ratio per square meter are ideal for investments. Now, you might think, Amber, is this ratio the ants pants of all the ratios? Is it that good or does it have any drawbacks? Well, as much as I'd like it to be, this ratio isn't perfect in all scenarios. So yes, over time, sought after land value will go up. But the catchphrase is sought after. That is one that everyone wants, or one that is or will be scarce in future. When deciding between a house and land package with the higher portion of land value and an inner city apartment with a lower land to asset ratio, be wary because both of them are not directly comparable. Each has unique factors influencing their value and investment potential and should be looked at through the demand and supply lens. Another thing to remember is that properties with high ratios might yield lower rental income. In the case of older houses, remember that they require more upkeep and less depreciation can be claimed for tax purposes. So to conclude, remember four things. 1. Use land to value asset ratio in forming a strategy. High land value ratios are typically preferred for long-term growth, while lower ratios might be suitable for short-term income generation through rental properties. 2. This ratio helps you measure risk. A high ratio suggests the chance for value increase and a risk of losing value in market downturns. 3. You can always hire me to show you how top investors don't wait for the opportunity to knock on their door. They build the door themselves. And finally, number 4, remember that I'm here to guide you through the property roller coaster, minus the nausea. So click the link below and schedule a call with me today.